Well, the Fed could keep liquidity high and interest rates low if the president and Washington lawmakers agree to slash the $1.4 trillion budget deficit. Roberto Perli is a managing director on ISI Group's policy research team. He spent 8 years in the Division of Monetary Affairs at the Board of Governors of the Federal Reserve System. Roberto joining us now from our Washington newsroom to talk about what the Fed may do going forward. Roberto, thank you very much for joining us. We appreciate it. I want to read you something that Larry Meyer, the former Fed governor, told us. He said monetary policy should always offset what fiscal policy does to the economy. He says Ben Bernanke would never say that, but that is the case. Do you think that that is indeed one of the duties of the Fed?
Oh, I think that is correct. Look, fiscal tightening does one thing. It slows down economic growth. And this means that if growth is lower, the output gap will be larger, will be wider than otherwise. And that calls for an easier monetary policy because employment will make slower progress and there will be fewer inflationary pressures. So I think that's entirely correct. That's the standard response that on any circumstance the Federal Reserve or most other central banks will adopt.
I'm curious. I mean, obviously there are different deficit cutting plans that are being bandied about. Does it really matter which one they'll adopt? I mean, is the economy going to be slowed no matter what if the deficit is cut down?
Well, it certainly depends on the details. There are certain plans could slow the economy more in the near term and less in the far term and vice versa. But I think the message certainly is always the same. Fiscal tightening is a drag on economic performance and therefore calls for easier monetary policy, which in the current circumstances I think means the Fed remaining on hold for longer or raising rates less if we get to that point than they would have otherwise.
Well, right now, if you look at what the market is pricing in, it seems to be, it keeps getting pushed back further and further and further. I mean, if we were having this discussion this time last year, we would have thought rates probably would have gone up already. So what's your outlook at this point, assuming that there is some sort of agreement on deficit spending cuts, on deficit cuts, excuse me, when do you think the Fed is going to move? Well,
let me say first that I do not think that the chances that Congress will agree on substantial fiscal consolidation that would put the U.S. economy on a sustainable fiscal trajectory, so those chances are not very high that they will do that in the near term. So even without that, I think with high unemployment and inflation that still remains fairly low, especially core inflation remains very low, sub 1% at the PCE level. So the Fed is in no rush to tighten policy at this point. So my outlook is that if everything goes well, if everything goes according to the Fed's forecast, we could probably see the first tightening, the first rate hike come around June of next year. Now, if by any chance there were to be some fiscal consolidation that's serious that happens before then that would push the onset of tightening even further out, possibly considerably further out. Let me just say though one thing about the market expectations. I mean, I think a common way to look at market expectations for Fed tightening is to look at federal funds futures and what they imply. Mm-hmm. Well, one problem with that is that rates are at zero right now, and therefore that introduces some biased risks to bet on rates going up because the cost of doing that is fairly low because rates cannot go down. So naturally, I think federal funds futures are a biased indicator at this point. They are probably not a true indicator of what investors expect. If we were able to look at the true indicator, I think investors would probably say that the first rate hike will come even later than the spring of next year, which is where federal funds futures are indicating at this point.
Well, it looks like that might not happen for some time. Roberto, unfortunately, we're out of time. It'll be curious to see what happens. I'd love to have you back on to talk more about this issue. Roberto Perli on the policy research team over at ISI, joining us from our Washington bureau to talk about the outlook for the Fed raising rates and the possibility that Washington comes to an agreement on the deficit. Roberto, thanks again. Appreciate it.